Well, good afternoon and welcome to AFME's webinar on T+1, what we learned from the US and what's to come next in Europe. My name is Pete Tomlinson. I'm a head of post-trade at AFME and I'm facilitating today's discussion. I'm delighted to be joined by a fantastic panel of T+1 experts. Some would even say T+1 geeks. We have Anthony Macchiarulo, Assistant Vice President at SIFMA, who worked extensively on the US migration. We have Andrew Harvey, Managing Director in the Global FX Division of the GFMA. Andrew Douglas, who wears many hats, but today is wearing the one that says Chair of the Technical Group of the UK Accelerated Settlement Task Force. We have Emma Johnson, Executive Director at JP Morgan, working on global custody industry development. And last but not least, we have Susan Yavari, a Senior Policy Advisor at Pharma, who will be providing us with the buy-side view. So thanks to every one of you for being here today. We're going to assume that everyone who's registered for this webinar is also a bit of a T+1 geek, or at least has an understanding of the basics. So hopefully we're going to be able to scratch a little bit further below the surface today. We welcome your questions in the chat box as we go. We'll try and address as many of them as we can. We're going to cover 3 jurisdictions, so the US, the UK, and the EU. And we're going to try and cover the past, what's happened so far, present, what we're seeing currently, and the future, what you can expect to see over the coming months and years. I think the best place for us to start would be the US. So we're speaking today almost exactly 1 month since go live. Anthony, coming to you first then, are SIFMA kind of pleased with the success of the project today? What are you seeing in terms of key metrics, key stats, in particular in terms of impact on settlements and affirmations?
Sure, thank you, Pete. And yes, SIFMA is very pleased with the results so far. SIFMA pushed a lot on the benefits of T1 with members, and it really has paid off. Initially there may have been concerns of elevated fail rates or low affirmation rates. Neither of that proved to be true. Some of the key benefits that we've seen so far, the DTCC actually published some of this on ust1.org, but in the T1 environment, the NSCC clearing fund decreased by $3.7 billion. So that really did hit the SEC's goal, that they set forth in the final rule. But also, actually, CNS fail rates were only at 1.9% on the first day of T1 settlement, which is a net reduction and lower than the May average in the T2 world. And also, the big rule was 15C62 and same-day affirmations. And we're pleased to see 95% almost transactions affirmed by the DTCC cutoff of 9 p.m. on trade date. The DTCC also posted some additional statistics for the period of May 20th through June 7th, and affirmation rates do remain high, around 95%. Fail rates remain low, around 2%. And as the industry, gets into a BAU status, business as usual, we're going to continue to monitor these results. And we'll also be monitoring the FX data as we get closer in the coming weeks. But so far, the data looks really strong, and we are very pleased with what we're seeing so far.
That's great. Thanks, Anthony. Emma, does that align with what you're seeing from a custodian's perspective?
Yeah, definitely. I think, what can I say? I think it's been a huge success, not just in the US, but also in Canada, Mexico, Argentina, Peru, Jamaica. But obviously, US grabs all the headlines. I think for the custodian community, I would certainly echo Anthony's sentiment. Just looking at this through 2 lenses, like through SIFMA, where active SIFMA members in the custodian community, but also through the AGC Americas Focus Committee, who had a T+1 working group that complemented and I think worked very nicely with SIFMA. And it was chaired by a colleague of mine, so I could see firsthand the commitment and diligence that went into the work, in the US. And I think really what we're going to probably hear the word collaborate a lot this afternoon. And I think that's really important because, yes, we're competitors in this space, but also we have a responsibility to jointly serve the client base and also support the broader, industry, in that it's not just your client who you are, interacting with, it's your counterparts, custodian as well. So there's a responsibility for alignment. And I think, yeah, I mean, one of the key successes I think we've seen, and that is like for broker sector, the investment manager sector as well. But just looking at this, like from a turning point, like for me in this project, was when my US colleagues came and done a roadshow to the European and Asia Pacific client base, and it all along on that journey, it really busted so many myths. What is an affirmation, the time zone component, and it really got all on the same page and on that journey. And I think, yes, there's some difficulties. Time zone, we can't change that as much as we may like to affirm by 9 p.m. But I think it proves that actually just working through some of these issues as an industry, it's amazing what you can do when you're all pushing and pulling in the same direction.
Absolutely. Thanks, Emma. You touched, both of you, a little bit on FX, which I think was talked about a lot, sort of pre-migration, as one of the main impact areas or areas of concern almost. Andy H, what have you seen kind of in the first month in terms of impacts on pricing, liquidity, trading patterns, volumes, etc. in FX markets?
Yeah, so thanks, Pete. I would agree actually with what you just said. So there's a lot of focus on FX, and rightly so. I mean, obviously FX is used to fund, the purchase and sale of those securities. So you need to make sure that the right funds are in the right place at the right time in order to fund that activity. So as a group, we've been working with our members and the wider SIFMA team for the last 2+ years, engaging in the US, but also in other jurisdictions to make sure that people know what's coming. And I think that the success we've seen in the US, as my two colleagues have mentioned already, is due to that considerable planning, preparation, but also that wider client engagement across all jurisdictions. And that's really led to a few things. So changes in behaviors, either in the client or the bank side, really to allow that change to T+1 to be successful. And that includes multiple different things, one of which, for example, is making sure you have people in the right time zone to trade in the markets when they're active. So I think what we've said, and Anthony touched on this, that initial phase has been successful. We need to monitor what's happening as these processes are changing. They're still evolving. It's obviously not yet steady state. We're still in early doors. But I think there have been a few things flagged for consideration before the move, as you just alluded to, not least that sort of provision of liquidity later in the US day. So it tends to be relatively thin on the FX from sort of 4 to 6 p.m. Eastern Standard Time. And that's before the Asian markets come online. But I think just to summarize what we've heard so far. So on the trading side, we've heard that banks were staffing later in the day, but they didn't see any major volumes going through. We've heard from some of the buy-side industry market participants that they were looking for repricing later in the day that wasn't available. But we haven't heard of any widening of those spreads, which you sort of just noted as well in your introduction. But some of those points are obviously commercial in nature, so I think these will be resolved between banks and their clients, as with any other need from a markets perspective. Settlement-wise, as Anthony just said, we'll keep an eye on that. CLS mentioned that they saw a shift in volumes later in the day. We haven't heard of any significant changes to volumes settling outside of CLS, which could be indicative of that increasing settlement risk. But let's not forget too, we've obviously seen a few periods of high volumes go through already. We had month end during the go live week. Last week, we had Juneteenth and the quarterly IMM roll. So those are record volumes for FX. And again, no major issues reported. And in the future, I think it's, keeping an eye on what's happening on the holiday, so Labor Day and so forth, because they may require additional extra cover. And really just to close, I think it's that evolution of the market as we go through the next few months to see what happens around about that end of day US time, so 5 p.m. Eastern Standard Time, when that market tends to roll positions to the next day. So I think we'll be keeping an eye on how that evolves.
That's great. Thanks, Andrew. Anthony, so you mentioned the reduction in clearing requirements as one of the kind of key benefits that's been observed so far. Has that reduction met, I guess, pre-migration expectations in terms of the level? Are there any other sort of cost and efficiency improvements that we're seeing, or is it kind of too early to tell? And we'll keep monitoring.
Yeah, it's a bit early, but we're still going to be monitoring, as Andrew mentioned. We're still looking at the FX data. But yes, the big number is 3.7 billion, and that is within line with expectations. That's almost a 29% decrease in the clearing fund. And as I've mentioned many times, by taking the risk out of the system, by reducing the time to one-day settlements, That's going to reduce both the aggregate market value of all unsettled trades and also the amount of time that counterparties to a trade are going to be subject to market credit risk. Also, as you know, the CCP may require less collateral from members, then they may also in turn reduce fees, and that could be passed down to market participants, including, you know, introducing brokers, broker-dealers, and institutional investors. And additionally, a reduction in a clearing broker's required margin could also free up resources to be used to mitigate risks of any other clearance and settlement processes that can be used to alternative uses. And finally, as we have mentioned in this forum already, other markets already have compressed their settlement cycles, Jamaica, you know, Mexico, Argentina, and investors who are deploying their capital abroad are going to enjoy the benefits of a compressed settlement cycle as well. But as mentioned, we're still going to be monitoring the coming months, especially the FX data. But so far, so good.
Yeah, and if I can just add something on that, I mean, looking at like lessons learned from the US, which is something I'm looking at quite closely. I think it's going to take some time. I mean, when are we clear that there's trends? When are we clear that there's certainty and that benefits have really been realised? And I think something that come up in the US lessons learned work stream of the UK technical group last week was the affirmation rates being so high, but the settlement efficiency rates being more or less similar. Is that something to explore? Because, you know, we're looking at reducing the risk, improving settlement efficiency, improving STP, but I'm hearing that, you know, the exception rates are somewhat the same as well. So I think it's about getting those trends, understanding those deltas, and really interrogating the results, because not taking anything away from the US migration, it's been fantastic, as I said before, but I think the devil's always in the detail, and now's the time probably to dive into that and keep all of us honest and allow folk like us in the UK and EU to learn from it even more.
Anthony, do you get the sense that firms are still in hand-holding mode a little bit, or are we moving towards a BAU environment?
What I've heard so far is firms are moving into a BAU environment. You know, there was initial concerns like, oh, is there increased staff just in the beginning, or is that going to last over the long term? And right now, under a BAU status, the data is staying strong, around 95% affirmations. So the DTCC is going into detail, looking at all the data in even more detail than that. But so far, so good. But as we mentioned, I think we need more time just to ensure that you know, this is a long-term benefit and it's going to stay with high and good metrics.
Thank you. Susan, maybe I can bring you in now, because I think one of the other sort of major things that the industry was worried about pre-migration was the impact of misalignment between major jurisdictions, between the US and Europe specifically in this case. How has that impacted the buy side so far? Has that increased costs and complexities? I think we've just had a question come through mentioning the funding gap that was talked about. So did that materialize, or has it all remained the same as sort of pre T+1?
So yeah, thanks a lot, firstly, AFME, for having me, and delighted to join this great panel on this topic. Yeah, firstly, I want to just respond to what Emma and others have said, just about, you know, how much look back we need to kind of draw the conclusions that we're kind of hoping to get from the US experience. And I have to concur that we do need more time. It's certainly very promising that, you know, there was no kind of major blow up, no, you know, nothing that kind of brought down markets, nothing of that magnitude. But yes, we are moving out of hypercare. We did have a period where the trading volumes that we saw were relatively subdued. So, you know, again, there is a sort of a concern lingering that, you know, what happens when there is a market stress, or there is, you know, just higher trading volumes that we have currently. And to your question, Pete, and I'm hoping to give just a bit of an illustration of what this challenge is for fund managers and why we've been so worried about this transition. But just in terms of the data that we can get and sort of what we can observe there too, I'm getting sort of early signals that there is an impact. There is some widening spreads on ETFs, but again, we need more time to be able to kind of parse out what's due to T1 and what's due to other factors. So yeah, so for anyone who was hoping to have like, okay, 6 weeks of this thing and we can just come out and you know, and make kind of very conclusive statements, I don't think that's not going to happen. So maybe if it is helpful, can I just explain a little bit what the challenge was for us? So at just a very basic level, it's a cash management issue, you know, and two things. It's an operational complexity, as you were saying, Pete, and the second piece is just additional cost. So if I just give a couple of scenarios of what happens under a US T1 environment and where Europe continues to be on the fund settlement cycle, you're looking at T2, T3, T4, so much longer. If you're selling European securities, you're rebalancing your portfolio, you will not get the cash until T2. But if you're reinvesting into the US, you have to settle their T1. So you have 1 day of shortfall, 1 day that you're having to fund that previously you were not having to do. Equally, if you're having subscriptions or redemptions into the fund, again, you're going to have either excess of cash or you're going to be short. So when you have a subscription, again, you're going to the market, you're trading, you have to settle within T1 if it's a US exposed fund, but the investor cash will not come into the fund until T2. So those are the kind of, scenarios that we're looking at. And, I can't emphasize enough, there's an operational complexity. So the tools that we have to deploy to manage the cash flow issue. There's a legal framework in Europe, right, which wasn't particularly designed, to kind of cater to this kind of misalignment. So we do have issues around cash breaches and borrowing limits that we're looking at, and we're trying to obviously avoid. And I think Europe and ESMA has moved towards a more harmonized approach, I have to say, across EU jurisdictions. That's good. Yeah, but I think ultimately, like for our purposes, it comes down to end cost to the investor, and also just generally the competitiveness of our products. If I focus on ETFs, European ETFs versus their US equivalents, what's happening there? Do we have a higher cost of trading, and is that going to harm us in the long term?
Thanks very much, Susan. That's really useful. A couple of questions have come in regarding securities lending impact, so I'm just wondering who to pick on. So I mean, I think to take them together, has anyone kind of noted any impacts from on securities lending and borrowing activities? I think we've seen some statistics from vendors which regarding levels of recalls, which might be something of a proxy for impacts, but the comment here is that there's no one true benchmark for understanding the impacts on securities lending market. So not sure if anyone wants to offer any thoughts on that. Anthony, maybe, or Emma.
Yeah, I mean, I'll happily try and answer that question. It's a very good question. I mean, like vendor statistics, I think one vendor noted 176% increase in recalls, which is like a mind-blowing statistic. In terms of what that means, I think it's very difficult to tell, and this is probably one for our friends at ISLA to help us out with. And ISLA have been very helpful in the UK technical group on lessons learned. But when you look at the fail statistics, it's like 2.3% for CNS fails and 3.3% roughly for non-CNS fails. So largely in line with pre-T+1. It suggests that the settlement efficiency isn't being impacted by the increase in recalls. It might come back to that people power element. We know that sec lending processing can be quite fragmented, can be quite manual. So I think the stress test could be the summer holiday period, and that might actually that might flush out some more issues, but that's really all I can see from what I've been discussing in working groups.
I definitely think there's a point in there that we have to figure out how we're going to actually assess the impact on that section of the market. Any other thoughts from anyone on securities lending? Andrew Douglas, I've not seen you so quiet for 20 minutes. Amazing. Turning to the UK, and your role as chair of the technical group, is there any immediate lessons learned for you from the US move? How has that maybe changed your thinking about your group's recommendations?
Well, thanks, Pete, and thanks for inviting me to speak. Yeah, it's been quite difficult sitting on my hands for 20 minutes. Yeah. Lessons learned for me. There are two things which came out of the US move, one very early on, and one subsequently, which was reiterated by Chairman Gensler at the meeting that we had, the task force work meeting we had last week. The first one is the importance of education, and that's getting the message out to as wide an audience as you possibly can. Those of you that have heard me speak will have heard me talk initially about leave no man behind, the old army adage. I was chastised about that. It should be leave no person behind. So it is leave no person behind, leave no institution behind. So it is important, and this webinar is very helpful in terms of spreading that message, that people understand what is happening. We saw the value of that in the US. And then the second point is certainty. The industry likes certainty. It might not like what you have to be certain about, but it prefers to know what it has to do. And Chairman Gensler said one thing last week which really resonated, which was the importance of picking a date and sticking to it. And the second message, which I'm picking up both in the UK and in Europe, is the importance of having regulatory support for the initiative. The industry needs to know that this is going to happen. As an example, I'm frequently asked, do I think that any change in government in the UK will lead to a withdrawal of support for T+1? The answer to that is clearly no. I think that any new government will have more to be concerned about than T+1. I think this is very much seen as an industry-led initiative, and the regulators and government are looking to be told what the right answer is, so we can provide our own certainty in that regard, which I think is a great place to be. We can tell the authorities what it is we want to do.
Thanks, Andrew. I was scouring the Labour and Conservative manifestos for a T+1 shout, but nothing in there. No. So how's the UK work progressing? What are the kind of major milestones that those people who are less close should be aware of?
Thanks for giving me the opportunity to make people aware of that. There are two things which are upcoming, which the industry needs to be aware of. Firstly, the task force, the technical group of the task force, is working very diligently, and in fact, we're approaching an internal submission deadline for the recommendations that we intend to make, which will form the backbone of an implementation plan in the UK for 2025. So this will be a list of things that we, the task force, believe that we, the industry, need to have achieved by the end of 2025 in order to be in a good place for the implementation of T+1 sometime before the end of 2027. We will be publishing that draft plan around the end of September, and that will contain a consultation so that people in the industry can have their say in what we, the task force, on their behalf have decided. I actually see it as a fairly simple consultation. In my head, it's one question. Here's the plan for 2025. Is there anything wrong with it? In terms of, are the things that are in there which shouldn't be in there in that form, or are the things, equally importantly, things that should be in there that are not? So keep your eyes out for that. That will be published around the end of September. There'll be a short period for the industry to provide their input to that, with a view to, by the end of this year, in line with the mandate that was given the task force, we will publish a final version of the 2025 implementation plan. This is what the expectation is that will be implemented over the next 12 months. And importantly, it will also contain the date that, again, we as a collective have decided is the most appropriate date for the UK to go live. sometime in 2027. I will reiterate we used to have two caveats to the date. The first one has now expired. The first one was what happens in the US. And we've seen that the US was let's call it a success, which has interestingly led to a shift in attitudes amongst certain participants who are now saying to me, why do we have to wait so long? US was a success. Why can't we do it earlier? But hey, let's walk before we can run. So that caveat has expired. I think we've seen that the US and their planning has been a success. The second caveat is that any decision that's made by the EU. So we're waiting with bated breath to find out what the conclusions of the current ESMA investigation are, on the basis that clearly from an operational perspective, aligning an EU, UK and Swiss move would be less hassle for participants. But as I think I've made it clear on a number of occasions now, the UK has made a decision to move, and we won't be waiting forever. So we need to get some feedback from Europe as to what it's thinking about its date is. But at the moment, two things: one, draft report end of September, then end of December, the final report with a date. They're the two things to look out for.
Brilliant. Thanks, Andrew. I guess the other sort of main jurisdiction that we wanted to talk about was the EU. So Susan, you've been heavily involved in the work of the sort of or the industry work in the EU on T+1. There's kind of a parallel tracks, right? You've got industry work and you've got the sort of regulatory process, which is ongoing as well. Maybe you could just give a bit of an overview of what's happening in the industry and from a regulatory perspective.
So yeah, I would say that on the face of it, we have very similar processes in Europe versus what's happening in the UK, in that we do have this originally AFME-led, as you know, AFME-led and then renamed EU T+1, involving 20+ trade associations looking at building a European roadmap for T+1. I think there are important differences with the two processes, and I would highlight three key areas where conditions are quite different. The first is that in the UK, though you do have a industry-led task force, it's still mandated by the government, and UK Treasury, FCA are involved every step of the way. They're there as observers, and sort of it's a concerted effort, which also means, and I think to Andrew's point earlier, it also means that when the time comes to sell that report, to put it out for consultation, and and to approve it, you will have a very short turnaround, I would think, and it's pretty much already representing the view of of the majority of market participants. So it's more of a formality. We don't have that. It's very much industry driven at this point. Maybe a word or two about where the regulator is and where the commission are. So with ESMA, as you know, we had call for evidence back in December 2023. We had an interim report in March, which kind of showed, I guess, the paucity of the responses in terms of actual quantitative evidence. So how much can ESMA deliver in terms of a cost-benefit analysis, I think it's fairly questionable. It is difficult. And it's a big ask, I think, for firms. So they haven't really delivered. It's been much more kind of qualitative in terms of what T1 looks like. Now, ESMA is set to report, latest we hear is end of this year, and legally mandated to report by January 2025. So that's the timeline you're looking at. That, I would argue, is very different to having the regulator in the room with you when you're having your discussions and as you're moving this thing along. So it's, yeah, that there's a big difference there. And then commission also, I would argue, is, we had kind of a big bang in January. We had this hearing, and Mairead McGuinness was on the record that this was no longer about if, but when and the how. I think we've lost a lot of momentum when it comes to commission, and we're now really hit the pause button because we're waiting for a new commissioner to come in. So yeah, so in terms of political signaling, I don't think we can expect much. But let me get back, if I could, just very quickly, Pete. So 3 key differences. A, we don't have the regulator and the policymakers sort of involved from the ground up. The second is about a date. Sorry, it's boring repeating things, but in the UK, you do have the state and 2027. And, you know, while it's not the transition deadline, it delineates a time window by which industry is expected to move. It could be 6 months earlier, 6 months later, but at least it's communicating to the market that this is coming and firms are aware. Again, we don't have a comparable situation in Europe. And the third one, perhaps this is a bit more original because it's stuff we've heard, but the third one is about preparation. And I feel like that what the UK task force is doing, and was in that Charlie Geffen report, this by 2025, you shall have, you know, processes in place to do your allocation confirmation and trade matching on T0. That's huge. That's a key milestone. And we're saying we've already identified it and we want it to happen at this time. So this preparation. And preparation, I think, is going to be even bigger lift for Europe. Anyway, I have other things that I can park. But for me, this is where the 2 processes are. They are parallel, and I think there's much greater momentum and more of a path to actual delivery on the UK side for the reasons I just cited.
Thanks, Susan. We'll definitely come back or stay on that theme. Emma, from your perspective, how important is it that there is this coordination between different jurisdictions within geographical Europe?
Yeah, and firstly, Susan, nothing you say is boring. It's very interesting. So, you know, you're amongst friends here. All is good. But yeah, I mean, I think I'm always very open that I would like to see an aligned European move. And why do I think that? I mean, probably 2 key areas. But firstly, commonality and cost. So despite the B word, Brexit, and despite the notable exception of the UK not adopting the infamous CSTR settlement discipline regime, the UK and the EU are typically more or less they have a common regulatory framework from a post-trade point of view, at least at this period in time. In addition, like market convention, it's also very similar. For example, a common framework for bilateral matching and settlement finality. And both jurisdictions have similar market practice with regards to post-execution operational processes, such as allocation, confirmation, trade level matching, settlement instruction, CSD matching and settlements. So much of what was in the Geffen report. There'll be certain market quirks, and there's certain market quirks within the EU, but we're talking about largely the same process and regulatory frameworks. And I think also just looking in real time, what we're doing in the UK with regards to the Geffen recommendations for trade date allocation confirmation, etc., in 2025, there's nothing stopping participants doing exactly the same in the EU. So front running the inevitable. I think also from an operational support point of view, processing systems will be set up very similarly, if not the same. We look at Brexit again, that's twice in one sentence practically. It's a political breakup, not a securities post-trade breakup. So from a market participant's perspective, when it comes to implementation, the same systems, the same processes, procedures, and so on would need to be changed and tested. And then the cost angle. Large scale change programs, which T+1, we should make no mistake, would be, are hugely costly. And there's been an eye-watering amount of investment into post-trade regulatory compliance over the past decade and beyond. And post-trade is always under the microscope for being costly. So the last thing we want in this industry, in my opinion, is duplicative projects, duplicative investments, system changes, testing and project teams. I think we should avoid this if at all possible. And there's no winners if this was to go ahead, other than maybe professional services and vendors who must think it's Christmas right now with the T+1 phenomena. And then I'm going to cover scope because I can see questions come in on referencing scope. And I think we could, again, like looking at the US experience, we've learned here scope is foundational. It's foundational for firms to set up their static data in their systems, to educate and work with their clients, to establish policies and procedures, for trade associations to establish market conventions and market practice. And I think if we can take one immediate lesson from the US was the dual listed securities between the US and Europe, which, you know, took some time to kind of iron out. But when we look at Europe, I think we have more instruments that straddle EU and UK exchanges and CSDs. But very fortunately, Mr. Douglas covers all ground, and misalignment and scope workstream have done a really cracking job in Andrew's technical group workstream, have identified a number of safeguards which would need to be applied if the UK and EU can't align for whatever reason. Using potential solutions such as, I think, safe harbour exemptions, FMI rulebooks, market practice again. But you know, the kind of purist in me would just say, I think if I was an investor as a non-European investor or non-European market practitioner looking in, I think that would be kind of hard and challenging to implement. I think any sort of diversion or exemptions just creates operational tension. So I think, you know, we're all wanting to give this a good go and see whether we can get alignment across the line. There's a commitment here, I think, within this group and also politically as well, from, you know, McGuinness back in January, but also in the Geffen report as well, endorsed by HMT. So I think we're on the right track, but this year certainly I think it's going to be very crucial. I'm sorry, I've probably spoken too long on this topic.
All good. Thanks, Emma. So, I mean, so the UK has set out 2027 as the date. So kind of cards on the table, Susan. Should and could the EU match that date in your view? You're on mute, Susan.
Thanks. I think there's no doubt that we want alignment. First and foremost, we want alignment with the UK. It just even thinking about a second misalignment scenario, which is exactly what this would be, and you know, it would be reliving what we're having with the US a second time, sort of, to the extent that some of our portfolios are exposed to the UK market. So I think we definitely want to avoid misalignment, and I think if that were to happen, and as Emma was saying, you know, the UK is already thinking about that, so that's kind of built into the roadmap. What are the safeguards? But I personally think, if we reach that point where we are misaligned, then Europe will really be isolated, because the US has gone, the Americas have gone essentially. Asia is probably very close to have, you know, ostensibly a much easier time, sort of, I would have thought, given that quite a few of those markets are doing T1 and T0. So I think they're having less of a debate about it and less cost benefit analysis, I would think, than what we're doing. So I hate to think how isolated we would be if, you know, if UK has gone and we're still kind of on a much longer path to T1 transition. So yeah, it's a scenario I don't like to think about.
Picking up on a couple of the questions in the chat, is it realistic, given, you know, some of the I guess the legislative process in the EU, the greater infrastructure fragmentation? Do you think that it is technically and physically possible to meet end of 2027?
So I think we have to recognize where we are, and I think some of the discussions we've had, and I think, yeah, Andrew was right to say that discussions have already changed. I mean, how could they not, you know, in terms of taking stock of how the US transition went? That's already informing all the debates and sort of increasing the pressure on the timelines. I mean, we just can't deny that. So I think if I'm Europe, I'm taking stock of where we are, you know, and there's still a path. We just have to readjust it. I think at this point we have to readjust, you know, and recognize sort of where the issues are. And I think we're all saying there's been a regrettable lack of political direction and sort of regulatory impetus. So that's lacking. Hopefully we can lift that. Hopefully we can change that. But the thing I'm thinking about mostly, Pete, is the UK has done really great valid work. So has the US. We already, you know, also on the FX piece that Andrew was talking about, and indeed our own firms, the operational changes that we had to sort of implement just for US T1 were already considerable, you know? So I think all of that can be leveraged. What we need to do is no duplicative efforts, as Emma was saying. So we leverage the work that's done and we hyper focus on the challenges that are very specific to the European market, you know, multiple CSDs, multiple CCPs, T2S. How do we adjust that? Agree on what the kind of those challenges look like, and develop the roadmap around that. You know, and then sort of waste less resource and less sort of focus there. And just one final thought. I was speaking to some of my members, I think only yesterday, and you know, just the fact that we have these T1 project teams in place today, still, as we say, maybe phasing out, but they're there. There's this concentration of expertise within firms looking at these topics. Wouldn't it be great to leverage that and keep them in place and not let the whole thing peter out and then start again at some other point, again, drawing more costs? So I think there's so much we could do, but we need to be awake and be very kind of agile and efficient about how we get there.
Thanks, Susan. Andy H, maybe coming back to you then. So from an FX market perspective, obviously, you know, we've talked about the preparation or the changes that was done for moving in the US securities market. Do you envisage it, as and when UK and Europe and other jurisdictions move to T+1, will there be more impacts or more changes from an FX perspective, or is the work largely done?
It's a really good question, Pete. It's obviously not FX specific because it applies to every other asset class that we've got around the table today, and you know, I'm sure other processes that people are thinking of. But the preparation point is key. So you know, I'm leading the UK FX workstream under the sort of bigger project that Andrew is running. So we have a really good group of individuals and organizations there across the full FX ecosystem. So buy side, sell side, custodians, venues, and so forth. And really sort of got through that process of understanding what the changes the FX market should consider moving through the UK. And Susan has the dubious pleasure of leading the EU work on FX. So we've been sharing the papers there as well, because I think that the points are exactly the same as we've spoken about. So I think that there will be changes in each jurisdiction, obviously, because the market participants that are the same in some capacity, but there are other market participants that trade in and out of jurisdictions that will not be trading, you know, in various different places. So that exercise that we've led has a deliverable for Andrew to dust off his passport and go and talk to other jurisdictions, say, look, this is coming. You know, your jurisdictions need to be aware that we're changing the UK, and this is what you need to start thinking about. We've also identified sort of a few other things for the industry to think about. I mean, the first point, really the headline, is that we haven't identified anything from an FX perspective that should stop the UK moving forward. So that's obviously good news. And I think the wider points that we've implemented to make the US a success are helpful for those trading FX to fund UK security activity as well. So there is some transferability there. But there's also a point, I think, that market participants will choose to operate different solutions depending on who they are, where they are, how they trade. So, you know, that one size fits all approach doesn't really fit. So whether it's a change of location strategies or combination of pre-funding or use of custodians or other providers, that there will be a mix of different solutions that the industry will tend to use. I think outside of what I've just mentioned, the big point for FX, as most of you heard me talk about for a while now, is around managing that settlement risk, so that risk of paying away currency without receiving the other side. And we're obviously keen to ensure that the market is aware of the benefits of using any PVP solutions, but also to use other processes to reduce settlement risk, so netting, for example. So those are not new concepts for the FX markets, but obviously if you shorten the time available from execution to settlement, it's not just a pricing or is liquidity available question. It's about how do you execute those processes in a shorter period of time to reduce those risks, settlement risk, as I've said, but also, you know, how do you perform those other time sensitive processes? So I think it's that full front to back process that needs to be understood. It needs to be understood how those risks can be mitigated, how liquidity can be accessed in a sensible manner, but then also how can the industry collaborate to make sure that the transition to the new state is as seamless as possible?
Thanks very much. I want to take a pause there because we've got some great and detailed questions coming in the chat. We definitely, as suspected, have some fellow T+1 geeks listening in today. Andrew, there's quite a detailed question around Middle East impacts, but I think just to broaden that out a bit, and I will try and get a more specific answer offline to the person who's asked this question. But this talks about how Middle East markets have adopted T+2 to try and harmonize with Western markets. How do we bring them along the journey and make sure they're involved in sort of T+1 discussions in the UK specifically, but maybe also applicable to the rest of Europe?
Thanks, Pete. And before I answer that, I just want to come back on one of the points Susan talked a little bit about isolation of the EU. And there's some questions in the Q&A about the misalignment between the UK and the EU and how important that is. One of the things that we tend to lose sight of, because we tend to focus on the cross-channel activity, is we're all misaligned from currently 55% of global capital markets, and the US, which have moved to T+1, and the US is a far bigger market for both the UK anecdotally for key European markets than we are important to each other. So there is more inward investment from the US and more outward investment to the US. So I would argue that being out of alignment with the US is more problematic to both the EU and the UK. And should the UK go on its own, to Susan's point, that becomes then a huge problem for the EU, because it will be out of alignment with a significant proportion of global markets, which will cause massive issues, I would have thought, for investment into the EU and investment out of the EU for all of the reasons we've talked about. So just to put that thought in people's heads. The specific question that you asked me, for those of you that are interested, I take this very seriously, and I am calling in from a hotel room in Brussels, because I'm out here spreading the word and trying to bring the UK and the EU closer together in whatever way that I can achieve. And it strikes me that dialogue is the best way of bringing the markets together, that we share what we are doing amongst each other and we learn from each other. So things that we've done practically to facilitate that, we now have observers. Susan is an observer from a farmer. We have EACH and we have EXTA, so the CCP and the CSD associations, who are observers to our task force in the UK. There is regular dialogue. I have regular catch-ups with my counterparts in the European. They're not strictly speaking my counterparts because they're in the authorities and clearly I'm not. But I speak with ESMA and I speak with the Commission and we update each other on where we're up to. There is also a more formal dialogue between the regulatory communities in both of those jurisdictions. And all of this is aimed at being as open as we can be to encourage the sharing of data. And hopefully at some point we will learn a little more about the European plans that will allow us to hopefully harmonise. But as I said, if that's not possible, then at least encourage Europe to make more rapid progress. In terms of the rest of the world, one of the things that we recently did, because this was raised during the working group, was how can we encourage other markets to understand what is happening in the UK, because the UK has a massive inflow of external investment, and all of those external investors will be impacted by a move to T+1. And Andrew talked about me dusting off my passport. Trust me, it doesn't have time to gather any dust. In fact, I probably need a new one because I'm running out of pages. So we have a list now, which we've obtained from official sources, of where the cash inflow to the UK comes from. And it's the usual suspects. It's the EU, it's the US, which is bigger, I have to say, than all of the EU countries put together. It's Australia, it's South Africa, it's all of those markets with whom the UK has had a historical relationship, but also new markets like Japan and Singapore. So we will look to spread the word. We recently I was pleased to see an old friend, Ben from ASIC, was at the conference in London last week, and through Ben I've already started reaching out to the Australian market. He's put me in touch with ASX. We'll also start talking to folks from the industry associations out there, and we will make steps to spread the word, because one of the things that we definitely don't want to be in the situation of is when we are migrating to T+1, we find that there are some key investors who simply didn't know that this was happening and so have made no provisions. This is about making the UK a better place, a more efficient place to invest. It's not about keeping people out.
Thanks very much. There's another question which I'll direct to you, Anthony. So recognizing that overall the US move was positive, what would you identify as the kind of the single one biggest challenge to making the move to T+1? And maybe to expand on that, what would also be your one piece of advice to those of us now going through the same experience here this side of the pond?
Sure. Yeah, so one of the main areas people were focusing on was behavioral changes. So internationally, being able to adhere to those new timeframes. But a few other things that come to mind is, of course, the new Rule 15c6.2 and the same-day affirmation requirement. That's something you did not see in 2017. And another thing that comes to mind is probably multi-listed securities and how to handle that. That's another issue that a lot of firms had questions on. All of those questions have been tackled, and currently there are no issues really to be seen around those parts. But just in terms of advice for the UK and EU, my main piece of advice would be preparation and collaboration early. In the US, we had numerous working group sessions with the industry, and we developed even the T+1 playbook and numerous documentation pieces around different areas that the industry was focused on, all posted onto a central area, ust1.org. And that was really beneficial. And then during the transition weekend itself, SIFMA held a command center, and that was only possible through the numerous years of preparation, but with the industry, and we had the key people on during that. So at least during the U.S. transition, we had, of course, the ICI, DTCC, and our international colleagues in Canada, Argentina, Mexico, Jamaica, Peru, as well as some key vendors as well. So any issues that came up during the transition or any questions, we're able to answer that right on the spot. A few things that come to mind, Jamaica and Peru announcing their plans only about the same week, a week before the T1 transition. So how do you handle those securities at the same time that are multi-listed with the US? So having that command center, open almost 24/7 during the 28th and 29th of May was really beneficial for the industry. So in sum, I would say stay engaged with the industry and have as many meetings and preparation and working group sessions as you can, and make sure that early is better. And that's kind of my advice.
That's great. That's really helpful. It was remarkable to see the sort of the dedication of the US industry and the number of people sort of staying up all night to see it through, yourself included. So something we've all got to look forward to in a couple of years' time, I guess. Taking a couple of questions together, which is really around the infrastructure environment in Europe, and maybe I'll come to you, Emma. So specifically, on mandatory partial settlement, do you think that that's something that we would need to implement here in Europe to move to T+1? And also, do you think that there's a need for kind of, I guess, greater heterogeneity, as it's called here, or sort of, you know, greater interoperability and standardization between some of the different market infrastructures?
Two of my favorite topics. So I think mandatory partial settlement, I think that's an interesting one. I think in a narrow context of T+1, I think we're looking at resiliency of the market. We want to maximize liquidity. We want to turn around those securities to keep the fluidity going. And I think partial settlement actually really helps to achieve that. It's definitely a topic for the CSDR refit, and there's going to be a consultation under measures to prevent settlement fails that ESMA are going to launch at some point this year, for sure. There's a lot of consultations coming this year, by the way. And I think there will need to be, in that consultation, looking at settlement efficiency through a T+1 lens. So I think that partials is definitely something we need to look at. We need to lock down a market practice across sector market practice, and I think partials play a very, very essential role there. And the other question was on protectionist.
Yeah, so I mean, maybe let's broaden it to sort of infrastructure harmonization,
yeah,
standardization.
Yes, definitely. Now, I think again back to that, you know, that reduced time frame, the need to keep liquidity moving, the need to ensure resiliency, and to actually look at this. You know, T+1 is a risk reduction technique. When Gensler you know, launched T+1, he done so on the proviso of safe, fair and efficient markets, and I think we need to be looking at that. What does that mean in our region? So, you know, I don't think there's any room for protectionism, but there's absolutely a need for, you know, breaking down those barriers, improving processes today that are inefficient in a T+2 environment, that will be absolutely exposed in a T+1 environment, and that will compromise the risk environment rather than actually improve it. So I would love to see, you know, more harmonization and integration at an EU infrastructure level. I think there's a commitment politically. It's very much evident in the CMU agenda. We spent a lot of time yesterday in an ECB committee discussing, again, removing the barriers to post-trade integration. So I think we'll see lots more here. It's definitely on the to-do list. It's very much out there as a must-do in this region. So hopefully we can avoid protectionism.
Perfect. Thank you. And maybe one final question to you, Andrew Douglas. What, in terms of setting the date in 2027 when the UK will move, what do you see as the kind of the key factors which will determine which date in 2027 the group ultimately recommends?
I was planning to leave myself on mute while I answer. Thank you for that corner you've backed me into, Pete. That's many of you will have heard me say this before. There's a famous theory espoused by that great securities expert Sherlock Holmes, who said in the commission of a crime, and I'm not suggesting that T1 is a crime, but in the commission of a crime, when you've eliminated all of the logical causes, then whatever remains, no matter how ridiculous, must be the right answer. And so I'm working on the basis that as we go through this process, we are eliminating certain dates. So the industry understandably doesn't like Christmas, doesn't like Easter, doesn't like New Year. So it's not going to happen around that period of time, you'll be pleased to know. We know there are dividend seasons, so we won't be doing it in September and we won't be doing it in March. We know that there is rebalancing and all of these annual activities, and eventually we will determine a window within which that is the logical time that we should be transitioning. We were given the full range of a 12-month period. So I see no point in backing ourselves into a difficult corner we need to pick a date which everyone is comfortable with and which everyone will be able to deal with. So as we get nearer the end of the year, I'm sure that will become clearer, and the date, I believe, will pretty much pick itself, in the sense that we will end up with a date where everybody converges in their thought processes and says, well, logically, that must be the date because none of these other dates work.
It's a great answer. We are, I'm afraid, at time. I would love to kind of continue this conversation. The hour's gone by very quickly. Huge thanks to all of my panelists for joining this afternoon. Huge thanks to everyone who stuck on the line and asked questions and listened in. If you're interested in discussing further, please contact AFME directly. We're happy to update you on the work that we're doing as an association, but also as part of the broader industry group. Thank you everyone for joining, and we will speak to you soon, no doubt. Thank you. Goodbye.